Hello and welcome back, guys. So in this particular session, what we will be discussing about is tiles from SPR's exam kit. Okay, so what we've been basically given is that tiles. There is a background information given regarding tiles. So tiles is a public limited company that prepares its financial statements in accordance with IFRS. Results over the past 5 years have been disappointing, and this has caused many of the largest shareholders to become increasingly disgruntled. Have been disappointing, right? This has caused many larger shareholders to be disgruntled. At the latest shareholder meeting, the board of directors was criticized for being slow to react to changing economic circumstances and for being overpaid. The shareholders told the directors that they expect to see substantial improvement in the recurring profit for the year ended 30th April 20x5, right? So deferred tax asset. First issue is that Tiles incurred substantial losses in the financial year 20x2, right? 30th April 20x2, 30th April 20x4. That means earlier year than this one, right? Then we are currently reporting. Okay, so for past 2-3 years, the financial year to 30 April 20x5, it made a small profit before tax due to non-operating gains. Okay, due to non-recurring items, which is not to happen all the time, right? This is extraordinary item, so we need to keep that discussion as well. So in the financial statement for the year ended 30th April 20x5, Tiles has recognized a material deferred tax asset in respect of its unused trading losses. So we need to talk about whether the trading losses can be recognized as deferred tax asset. So if they provide a convincing evidence that it will generate future profit against those unused trading losses, then only it can be recognized as deferred tax asset, right? So we will talk about that as well as per IAS 12 income taxes. So this was based on the budgets for the year 20x6, 20x9. Okay, so this was on the budget. The director instructed the financial controller to include high growth rates in this budget due to positive indication. So it is just indication, no concrete evidence, right? From customers about future orders, as well as Tiles plans to expand into new markets and to sell new products currently under development. The tax losses expire in 20x9. Okay, so if it is unused, it expires after 2-3 years, right? And then the second issue is discontinued operation. IFRS 5 assets held for sale and discontinued operation, right? On 1st Jan 20x4, the shareholders had, at a general meeting of the company, authorized the directors of Tiles to sell all of its holding of shares in a subsidiary within the year, right? So that means by 1st Jan 20x5. We are reporting for 30th April 20x5, right? Tiles has shown that subsidiary as an asset held for sale. Okay, it had shown, right, and presented it as discontinued operation in the financial statement for the year ended 30th April 20x4 and 20x5. So 30th April 20x4 it was held for sale. 30th April 20x5 it was changed into discontinued operation, right? Tiles made certain organizational changes during the year to 30 April 20x5. Okay, this is completely wrong, because when you make organizational changes like that, so our first criteria of assets held for sale is the asset should be available for sale in present condition, right? Immediately, right? So since the changes has been made, that is evidence that it was not yet ready to be classified as held for sale, right? So it has been wrong from the very beginning, right? The classification itself has been wrong from the very beginning. We will talk about that as well. So which resulted in additional activities being transferred to subsidiary. Subsidiary made a significant losses in both 20x4 and 20x5. Okay, so why have they could be doing this? Because see, like what happens is when you classify it as assets held for sale, discontinued operation, right? So what you normally do is you present it on a separate line basis, right? So that way it seems like a non-recurring item, right? So it looks favorable in the eyes of investor. That's why they might be doing it. We'll talk about that as well. Disclosures of bonus, third issue. So this will be a related party, right? So transaction between key management personnel and the entity, right? Okay, so this is about related party. So during the year ended 30th April 20x5, the directors of Tiles accrued large performance-related bonus. These are payable in the year ended 30 April 20x6. Okay, so exactly after 1 year, all accounting entries relating to this bonus have been posted correctly, but the finance director has omitted the expense from the current year directors remuneration disclosure note, right? So they had talk about this as well. So they were shareholders were disgruntled, right, for being overpaid, right? So we need to talk about that as well. And then if they don't disclose it, so see, this believes that disclosure of this event would lead to negative press about Tiles and would cause employee and shareholders dissatisfaction, because of which may depress Tiles share price. The shareholders was therefore justified non-disclosure on the ground that it will maximize shareholders' wealth. Okay, what a reason, right? In this world, you can come up with any reason just to justify yourself, isn't it? So required explain how the above transaction should be dealt with in the financial statements for the year ended 30 April 20x5 and discuss the ethical issues raised. Professional marks will be awarded in this question for the application of ethical principles, right? So first thing first, deferred tax asset. Tax assets. Next is discontinued operation. Disclosure of bonus, and then end will be always about ethics, right? So let's talk about IS 12 first of all. A deferred tax asset should be recognized for deductible. Two words in this. It is deductible. When there is deductible, that means to reduces our liability, right? That's why it's a deferred tax asset. Whereas if it's other wording than deductible, taxable, then it means that it will increase our liability. So that is our deferred tax liability. Okay, so always remember this. Deductible temporary difference. Then deferred tax should be recognized for deductible temporary difference, and then unused tax losses, right? That's also our asset. And unused tax credits. To the extent, okay, EXTNP, to the extent that it is probable that taxable profit will be available in the future, okay, against which the deductible temporary difference can be used. Okay, so it should be probable as well. Otherwise, see, like what can happen is that if the company, if you don't, it is not probable that the company will ever be profitable, then what's the use of recognizing deferred tax asset, right? So it will never be used. So it is. So that's what basically this thing means. Okay, so it's doesn't make any sense, just to recognize it as a deferred tax asset. Okay, so let's go on talking about IAS 12. According to IAS 12, income taxes, the existence of unused tax losses is strong evidence. So it already exists, right? Unused tax losses. So that's a strong evidence that the future taxable profit may not be available against which to offset the losses, right? So therefore, when an entity recognizes or when an entry has a history of recent losses, the entity recognizes deferred tax asset arising from the unused losses in this case we are talking about losses, so I'm specifically focusing on losses only. Okay, the entity recognizes tax assets arising from unused tax losses only to the extent that the entity has sufficient taxable temporary difference. Okay, taxable. Okay, not deductible temporary difference but taxable. Taxable temporary difference, or there is convincing evidence that sufficient taxable profit will be available. Okay, so let's talk about this particular case. So tiles have a history, right? As tiles, remember, it has a history because it has not turned profit, substantial losses from 30 April 20x2 to 30 April 20x4, right? History of recent losses from 30 April 20x2 4, right? It needs to provide convincing evidence that sufficient taxable profit would be available against which the unused tax losses could be offset. And it has improved as well, right? So due to non-operating gain, okay, so that's, we need to argue about that as well. Okay, the improved performance 0x5. So what was it regarding non-operating, right? It's about non-operating gain. Okay, good. Would not be indicative of future good performance, as tiles would have suffered a net loss for tax had not reported non-operating gain. Right? If it were not for it, it would not have any gains, right? Positive indication from customer, right? So nothing in concrete. Tiles anticipation of improved future trading not alone be regarded as meeting requirements for strong evidence of future profit. When assessing the use of carry forward tax losses, weight should be given to revenues from existing orders or confirmed contracts, right? So it's rather than those that are merely expected. Actual revenue should be given importance, not the expectation from future trading, right? Not the expected revenue, but the existing revenue will be considered strong evidence. Okay, if it had that, it would have met the criteria, but since it does not have any, it only has expectations, so that's not concrete. So thus at 30 April 20x5, it is unlikely that this entity would generate taxable profits before the unused losses has expired. Price is not able to provide convincing evidence that sufficient taxable profits would be generated against which the unused tax losses could be offset. So the recognition is not according not adhering to, it's not following IS 12, right? So I think that's pretty much it. So it has already recognized it, right? And then next is deferred discontinued operation.